Good morning, friends. Welcome to Weekly View on Markets. The news from the market for the week is not very good. The market has been continuously making lower tops and lower bottoms, and the market is grinding to lower levels every week. This week, Nifty has closed at 16,945 and it is down by 155 points with a cut of 0.91%. Bank Nifty also fell by almost 200 points with a cut of 0.51%. Mid-cap index saw major losses, lost about 526 points and closed at with a loss of 1.75%. Small cap index lost about 1.88% and closed at 9094 levels. So India VIX, that is the volatility index, closed at 15.24 and index has gone up by 3.18% for the week. So almost all the indices have lost during the week and the overall picture of the market is not looking good at all. Let us look at weekly sectoral performance. Few sectors like pharma, healthcare, FMCG have gained about marginally 0.4 to 0.6%. Otherwise, most of the sectors ended in big losses. Realty sector lost more than 4.5%. Metals, PSU Bank lost about 4 and 3%. IT index lost about 3%. Infrastructure and all other sectors lost 0.5 to 1%. So there was a overall selling in the markets. Let us look at the charts to understand, what is happening, why the sentiment is so low in the markets. This is the daily chart of Nifty. I have maintained the same channels and support line which I had drawn last week. So the market is moving in a channel. It is called a downward trending channel, and whenever there is any recovery in the market, people are selling due to one or the other reason, and market is coming to the lower levels. So for the next week, the support level for Nifty will be at around 16,800 levels. I am not very confident whether this level will hold or the Nifty will break this level also. Looking at the intermediate trend, it is very difficult to predict where the bottom will be for the market. And every time there is one or the other bad news coming from the global markets, which is pushing our markets down. The traders have to be very careful and trade with strict stop losses. And for investors, these dips are providing good opportunity to buy. So the resistance for the Nifty will be at 17,200 for the coming week, and support is at around 16,800. Now let us look at Nifty Midcap Index. Midcap Index has broken its support of 30,000 and ended at 29,565. It has fallen more than 500 points in a single day on Friday. So there is a overall selling in stocks, especially led by FIIs. So we'll see the fundamental reasons why there is continuous selling by FIIs in the next section. So the support level for mid cap index is at around 29,500 level. We'll have to wait and watch whether this level will hold or it will break even this level. Then if this breaks 29,500 level, then we may see 29,000 in the mid cap index, and now 30,000 will be the resistance level for the Nifty mid cap index. This is the Nifty small cap index. I was very hopeful that the small cap index will hold 9,000 levels, but it has not happened. So it has broken 9,000 levels and closed at 8,923. And mid cap index has lost more than 1.8% during the current week. So it's very difficult under these circumstances to estimate the bottom. But I hope 8,800 levels should be a good support level. And from here, Nifty small cap index should take support and pick up. So the valuations in the small cap index space is very, very attractive at present. So it is supported by the fundamental. So I hope that 8,800 level will be a good support for small cap index. Let us look at Nifty Bank Index. Again, the bank index has broken 40,000 and closed at 39,395. So next support should be at around 38,200 to 250, and 39,800 will be a resistance level for the bank Nifty in the coming week. So the chart structures of all the indices doesn't give a very encouraging view. So the short-term traders have to be very careful during such a market situation. There is a high volatility, and definitely the chart is indicating it is a sell on rise market. Now let us look at the market fundamentals and the economic indicators. Third quarter GDP growth has come last week. It has come at 4.4%. It is at a lower level comparing to the previous quarters. So, but the full year FY23 estimate has been maintained at 7%. So, the GDP numbers indicate signs of demand slowdown in the recent months comparing to the earlier quarters. And also another reason for the lower GDP growth rate is the base effect, because we had seen, in the previous year quarters, the market was opening up and pent up demand was there. Now, in the earlier quarters, it was on a low base, whereas in this quarter, it is on a higher base. That is the reason that the GDP figures looks little lower. But the full year GDP estimate is at 7%, which looks quite good. RBI forex reserves has slightly gone up, and it is at 570 US dollar billions. Crude prices is at 74.99 level. It is hovering between 70 and 75 level. Forex rate of rupee is at 82.48. So there is improvement in rupee rate, INR rate in the recent weeks, as dollar index has dropped from 114 to 103.12. So this has resulted in a more stable and Indian rupee rate. Gold prices have gone beyond 60,000 last week, and it is at 61,270 per 10 gram. Whenever there is some crisis like uh, this bank collapse or any kind of financial crisis, the gold is considered a safe haven investment. This is the result we are seeing that last 1 month the gold prices have shot up almost from 50,000 per 10 grams to 61,000. US Fed meeting was there last week. They have hiked the interest rate by 25 basis points, which was as per the street estimates. And why the markets are nervous is that Fed has indicated they are ready to hike the rates even further in the coming months if inflation does not come under control. And they feel that the inflation is very sticky. So they have maintained a hawkish stance. That is the reasons that after the Fed meeting, markets have become a little nervous, coupled with the crisis in some of the banks. We have seen continuous FII selling in Indian markets because when the interest rates keep going up in US, the investments in debt instrument in US can get higher returns for them. That is the reason they are selling not only in India, in most of the emerging markets, and money is moving to the US debt market. In the first week of April, there is a RBI Monetary Policy Committee meeting is there. We'll have to wait and watch how RBI is going to take decision on the interest rates and what kind of stance they are going to adopt for the Indian economy. That will have a bearing on the stock markets. FII have been selling and they have sold 246 crores in this month so far, whereas domestic institutional investors have bought 25,593 crores in this month. While FIIs have been selling, the domestic institutional investors have been continuously buying, and there is a lot of money coming into the market via retail investors investing through equity mutual fund SIPs. The continued interest of retail investors in the stock markets and their approach in last 2 to 3 years has made a lot of difference to the Indian markets. That is why we are seeing that the market is able to withstand FII selling pressure, and still, market is not falling off from the cliff. There is one more slight bad news for debt mutual funds. The long-term capital gain tax and indexation benefit on debt mutual fund has been removed from April 23, that is from the next financial year. So the debt mutual funds which hold less than 35% equity, they will lose indexation benefit, and the gain from these mutual funds will be treated as short-term capital gain, which will be included into the income of the individual and will be taxed at the slab rate. So this makes investment into debt mutual funds slightly unattractive for retail customers, and this may help banks to mobilize higher deposits. One thing we have to see in the market is that FIIs are using the dips in the market to buy continuously, supported by the investments by retail investors through mutual fund SIPs. So, though the market is falling, the market is not falling off too much, but it is grinding lower and lower. And any sharp sell off at these levels will give a good buying opportunity for Indian investors. So people should invest in good quality stocks, use these opportunities to buy good stocks, which will give excellent returns in next 2 to 3 years. and mutual fund investors should continue their SIP investments. It will benefit them for a long term. So this is all for this week. If you like my video, please subscribe to my channel, share with your friends, and give your comments. We will meet again next week. Thank you.